Simon Property Group stock, ticker symbol SPG. This stock is up 9% on the year-to-date chart, which is higher than your average REIT year-to-date. On the 5th of February, SPG presented earnings where they missed on FFO big time, but beat on revenue. And people love SPG stock because of multiple reasons, one of the main thing being the dividend. And I understand why with dividend yield at almost 5%. If we look at the past 5 years, we see that SPG underperforms the S&P 500 big time. And keep in mind, this is including dividends. So could this be the perfect time to buy SPG stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does SPG do? Simon Property is a real estate company focusing on traditional malls and premium outlets. When we dive in the most recent earnings report, we see that net income was reported at $747 million, or $2.29 per share, up from $673 million or $206. FFO, one of the most important numbers, was also up similarly to the net income, both looking pretty decent to me. NOI increased 7.3%, also looking pretty good to me. Occupancy rate was reported at 95.8%. And this looks really good to me since it is increasing and finally crossing the 95% mark. For the full year of 2024, SPG expects to report a net income per share in a range of $6.45 to $6.7, only a small increase on the high end versus last year. FFO is expected to be in a range of 11.85 to 12.10, which is in line with 2023 numbers. To me, this outlook doesn't look too exciting. A thing that I do like is that most ratings are A credit ratings. This comforts me a lot. And another interesting thing is the fixed charge coverage ratio, sitting at 4.3. This is also looking pretty decent. And here we see the breakdown for type of real estate and states. 71% of the revenue is coming from US malls and outlets. International is sitting at 9%. They have a niche focus with malls and outlets, but you can argue if this is future-proof. Looking at the states, we see that Florida represents almost 90% of the portfolio and California 14%. I prefer 10% at a maximum, to be honest. Another interesting thing is that SPG isn't growing more properties. All subsegments report the same number or less year over year in amounts of properties. On top of that, in 2025 and 2026, roughly 22% of the leases expires. And probably they will renew the contracts, but it is still something to keep your eye on. Looking at the top tenants, we see that Macy's is the biggest tenant with 11%. To me, this looks pretty good. I prefer 10% or less, so they are almost there. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue diving into the fundamentals. SPG is a 51 billion market cap company. P/E ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at almost 15.7, indicating they are trading around their fair valuation. Later in this video I will show you my 3 price targets for SPG stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 5.66 billion and in this graph we see that revenue went up in the long run. The lockdown periods had a big impact on the revenue and they never fully recovered from it. we see that margins are going up over a longer period of time, which is looking really good to me. Especially the net margin is looking really good. EPS is showing similar trends as the margin and the revenue. For a REIT, it looks pretty decent. Analysts have mixed feelings about the EPS growth. It doesn't look too exciting to me, to be honest. It is expected to stay flat in the coming 5 years. For the revenue, it is also looking very interesting with low single-digit growth expectations. Not really exciting if you ask me. Return on assets is sitting at 6.85%, which is a decent number for a REIT. Return on equity is looking really good, and the most important number, return on invested capital, is sitting at 8%, which is a great number for a REIT. It is higher than the 5-year average, so that is also looking really good. Current ratio is at 1.77, which is a decent number for a REIT. Nothing really special to mention here. Right now, SPG has 26.5 billion in debt, and I prefer companies that can pay down at least a big chunk of the total debt with the total cash. SPG has 1 billion in total cash, so they can't pay down a big chunk of the total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Again, the lockdown periods had a big impact on the business. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at almost 5%, which is a great number. Annual payout is at $7.8 and payout ratio is around 65%, which is below the 75% average for REITs. The 5-year growth rate is at -1%, which is a big disappointment of course, but they increased the dividend for 2 years in a row now. In here we see the dividends paid since 2012 and we immediately see the effect of the lockdown periods. After that they started to increase the dividends again at a high pace. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at a historical rate from here. And overall these dividends look pretty good to me, but how about the historical returns? I decided to compare SPG stock with the overall market, in this case the S&P 500. Next to that I added Kimco and Regency Centers. On the 5-year chart we see that SPG only returned 13.8%, and this is including dividends. The S&P 500 did return 103%, massively outperforming all stocks in this list. On the 1-year chart it looks pretty interesting with SPG returning a whopping 60%, beating everyone in the list. Almost twice the return versus the S&P 500. On the 6-month chart it is the same story with SPG returning almost 48% and again double the return of the S&P 500. On the 1-month chart it is again SPG that is the winner here. So bottom line, the S&P 500 was by far the better investment in the past 5 years. But most recently SPG is getting some momentum. So could this be the perfect time to buy SPG stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 2, 4 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 38, 40 and 42%. For the free cash flow margin I'm putting in 53, 55 and 57. For the PE ratio I'm putting in 20 since it is a REIT. And for the price to free cash flow I'm putting in 13, 14 and 15. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, SPG stock is around $156. I hit analyze, and we only see red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $97. We have a mid price target of $120, and we have a high price target of $148. To me, the mid to high price target is the most justified here, indicating that this stock is still overvalued. Please let me know the price target that you think is the most justified in the comments down below. My final conclusion on SPG is that this is an interesting stock. They have a niche focus which a lot of people seem to like. But I'm not a big fan of this niche focus, to be honest. I'm not saying there will be no malls or outlets in the near future. They always will have a place somewhere. But I do think it is going to decrease in the coming decades. It has to be said that most fundamentals look pretty steady. They keep on growing the revenue and FFO. The thing that I don't like is that they aren't acquiring more properties. There is no external growth here. From a dividend point of view, things look pretty good with a 5% dividend yield, and growth numbers are also back on track again. From a value point of view, things don't look too exciting. This stock went up pretty big amount lately, and it is looking overvalued to me. That's also the reason why I'm going to skip this stock, but I will keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor, and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching, and I will see you in my next video.